Look at this candle right here. Price comes in fast, breaks through a clear level, wicks down hard, and then, within 3 candles, completely reverses and drives in the opposite direction with force. That is not random. That is not noise. That is a sequence. And once you understand that sequence, you will see it repeated across every time frame, every market, every single session. Now look at this chart. Price has been ranging. The highs are clean. The lows are clean. Retail traders are watching this range, drawing their support and resistance lines, waiting for a breakout. And right here, price breaks below the range low. Their stop losses trigger, their short positions activate. And then immediately, within the same candle, price reverses violently to the upside and never looks back. The people who got stopped out watched the market go exactly where they thought it was going. But they were already out of the trade. That is not a coincidence. That is engineered. That is how the market actually works. And everything you are about to see in this lesson will show you exactly how this happens, why it keeps happening, and how you can position yourself on the right side of it. Watch this displacement move right here. Aggressive, impulsive. 3 candles barely have any wicks. Price is moving with intention. This is not a slow grind up. This is not an overlapping consolidation. This is a one-directional thrust with real commitment behind it. When you see movement like this, you are watching the footprint of institutional activity, and the key insight, and the one most traders miss, is that displacement like this almost always creates a gap in price delivery. A zone where price moved so fast, so aggressively, that it left a pocket of inefficiency behind. That pocket is important. We will come back to it. Now watch what happens next. Price pulls back, slowly, methodically. It retraces into that pocket, and right there, at the exact level where that inefficiency sits, price reacts and resumes the original direction. That is the trade. That is the entry, not the breakout, not the momentum chase. The return to the origin of the impulse. This is the foundation of everything. Price moves in impulses. It leaves inefficiencies. It returns to those inefficiencies, and then it continues. That cycle is what drives markets. And once you can see it on a chart, actually see it, not just understand it intellectually, you will never look at price action the same way again. Let me show you something else before we slow down. Look at this series of swing highs here. Every single one of them attracted price. Every single one of them created a reaction. But look at where the real money is sitting, not at the swing highs themselves. Above them, because above every swing high, there is a cluster of stop losses from traders who shorted that level and placed their stops just above it. There are also buy stop orders from breakout traders waiting for price to push through. All of that liquidity sits just above the obvious levels, and the market is a magnet for liquidity, always. That is not a metaphor. That is mechanical reality. Price moves toward where orders are concentrated. When there is a cluster of stops above swing highs, price gravitates toward those highs. When there is a cluster of stops below swing lows, price gravitates toward those lows. Understanding this one principle changes everything about how you read a chart. You stop asking, will price go up or down? And you start asking, where are the orders and which direction does price need to move to reach them? Now, let us slow down. We have covered a lot of ground in the opening, and now we are going to go deep. We are going to take one chart and walk through it from beginning to end, building understanding layer by layer. The concepts that follow are not independent. They connect. Each one builds on the previous, so pay close attention to the sequence, not just the individual ideas. Here is our working chart. This is a 4-hour chart. We are going to mark up this chart progressively as we go through each concept. The first thing to understand is market structure, and I want to be very specific about what market structure actually means because most explanations of it are incomplete. Market structure is the record of where price has shown intention. Every time price makes a new high with conviction, it is saying something. Every time it makes a new low, it is saying something different. The pattern of highs and lows tells you the directional bias of the market at that degree of structure. But here is the part that gets skipped in most educational content. Not all highs and lows are equal. The market does not treat every pivot the same way. Look at this chart. There are small pullback highs scattered throughout the move. Then there is this high right here, the one that formed after a significant displacement lower. This high is different. This high marks the point where price shifted from moving in one direction to potentially moving in another. We call this a point of interest, a significant swing point, because it was formed at the peak of a move that then created a meaningful displacement in the other direction. Every minor pullback high above this level is just noise compared to the significance of this structural pivot. When price later returns to sweep the liquidity above the minor highs, those small clustered highs you can see right here, it is not breaking structure. It is hunting the stops. It is reaching for the liquidity that is sitting just above those obvious levels. And notice how it does it, quickly, decisively, and without sustained follow-through above those levels. The sweep happens and then price reverses. That reversal, the failure to sustain above those highs, is itself information. It tells you that the move above was not a genuine structural shift. It was a hunt. Now compare that to what happens over here. Price sweeps the high. Price then closes with body commitment above it. The next candle opens and pushes higher. The next pullback fails to come back down to the sweep level. This is the difference between a liquidity sweep and a genuine break of structure. The sweep does not have follow through. The break does, and the market will test your ability to distinguish between them constantly. Let me define break of structure properly, not as a term, but as a behavior. A break of structure occurs when price displaces through a significant swing point, closes beyond it with a full-bodied candle, and then fails to immediately return. The key word is displaces, not wicks through, not slowly grinds through, displaces impulsively. When you see a slow, grinding move through a swing high, price is usually consolidating, not breaking. The momentum of the move matters as much as the price level itself. Now look at this candle right here. This is the displacement candle. It is larger than the surrounding candles. It has minimal upper wick. It closes near its high, and it closed above the significant swing high we had identified. This is a break of structure to the upside. This candle is telling you that the market has decided. Buyers have stepped in with enough force to shift the structural narrative. Before this candle, the market was bearish in its behavior. After this candle, it is no longer. This moment, this precise shift in market behavior has a name. It is called a change of character, and it is one of the most important signals in reading price action. Before a change of character, you are looking at a market that is showing one directional intention. After it, you are watching the market signal that intention may be reversing. The reason this matters practically is that it tells you when to stop looking for trades in the old direction and start looking for opportunities in the new direction. Here is how to identify it with precision. You are watching a downtrend. Price is making lower highs and lower lows consistently. Each pullback into the structure is followed by a continuation lower. Then, and this is the trigger, the price creates a swing low, pulls back upward, and instead of reversing and making a new lower low as it has been doing, it closes above the previous swing high with a full-bodied impulsive candle. That is the change of character. That is the first signal that the bear structure is ending. Now, after a change of character, you do not blindly enter. You wait for the break of structure confirmation. In an uptrend scenario, that means price has put in a change of character at the swing high level, pulled back, and then broken above the most recent swing high with conviction. Now you have both the signal and the confirmation. The market has officially shifted character and confirmed structural change. Look at this sequence right here on the chart. You can see the lower highs and lower lows clearly. Then the impulsive move up creates the change of character. Price retraces, and then right here it breaks above that lower high. That is the break of structure that confirms the trend shift. The sequence is: displacement creates change of character, retracement gives you patience, break of structure gives you confidence, and the trade is taken on the return to the origin of the impulse that created the displacement. That return is what we will discuss next. When price displaces aggressively, it leaves behind something called a fair value gap. This is the zone in price where the movement was so rapid that normal two-sided trading did not occur. Think about what happens during a normal balanced market. Buyers and sellers are exchanging at similar prices, and price moves slowly, filling in the range. But during an impulsive displacement, price moves too fast for that balanced exchange. The result is a range of prices that were barely transacted, a gap between the low of the candle before the impulse and the high of the candle after it. Let me point it out exactly. Here is the impulsive candle. The candle before it, its low is right here. The candle after it, its high is right here. The gap between those two levels is the fair value gap. It is literally a zone where price did not spend time. And because price has a natural tendency to return to and retest areas of imbalance before continuing, the fair value gap becomes a high probability zone for the next reaction. Now here's the nuance that most traders miss. Not all fair value gaps are equal. The location of the fair value gap within the broader structure matters enormously. A fair value gap that sits within a bullish break of structure, aligned with a higher time frame bullish narrative and located at a significant area of value, that is a high quality zone. A fair value gap that forms during a counter trend move in the middle of a ranging market with no alignment to higher time frame structure, that is noise. Context is everything. The fair value gap is not the setup. The fair value gap is the entry mechanism within a setup that already has structural alignment, directional bias, and liquidity logic working in its favor. When all three of those elements are present and price returns to the fair value gap, you have a high probability trade location. Watch how price behaves when it returns to the fair value gap right here. It does not race through it. It slows down. Sometimes it puts in a small wick. Sometimes it forms a consolidation pattern within the gap. But notice what it does not do. It does not close below the bottom of the gap with conviction. A bullish fair value gap should hold the midpoint or the lower boundary with at least a significant portion of the candle body remaining inside the zone. If price slices straight through the fair value gap and closes well below it, the structure has failed, and you do not hold the position. Let us now talk about what is actually driving price toward the fair value gap and away from it after the reaction. Because this is where the logic of smart money concepts becomes truly cohesive. The movement of price is driven by one thing: the pursuit and delivery of liquidity. That is the engine. Everything else is just the structure around it. Liquidity comes in two forms. External liquidity sits above swing highs and below swing lows. Those clusters of stop losses and orders that pile up at obvious levels. Internal liquidity sits within the range between highs and lows. The equal highs and equal lows that form inside a structure. The trend line touches that attract price as they accumulate stops. Both types of liquidity are targets. The market is constantly moving from one pool of liquidity to the next. Here on this chart, let me identify both. Up here, above this series of equal highs, that is an external liquidity pool. Every retail trader who shorted these highs has their stop loss sitting just above them. Every breakout trader waiting for price to push higher has their buy stop just above them. That is a concentration of orders, and the market will seek it out. Down here, below these two nearly identical lows, that is another external liquidity pool. Stops from long positions sit just below these lows. Sell stop orders from breakout traders expecting a break, lower sit just below them. Same logic, opposite direction. Now look at the actual path price took. It moved up, swept the equal highs, took the external liquidity from the buy side, and then reversed sharply lower. On the move down, it swept through these equal lows, took the sell side liquidity, and then reversed impulsively higher. See the pattern? Price ran up to take one pool of liquidity, reversed to take the opposite pool, and then ultimately moved in the direction it was always intending to move. The liquidity sweeps are the mechanism by which smart money fills its orders without causing excessive slippage. By driving price into a cluster of orders, they are creating the counterparty needed to fill large positions in the opposite direction. This is the part that fundamentally changes how you think about stop losses. When you place your stop loss below an obvious swing low, you are not just protecting your trade, you are adding your order to a cluster that the market is going to hunt. Your stop loss is literally liquidity, and the professional money knows exactly where retail traders place their stops because retail traders are predictable. They use the same levels, the same patterns, the same logic. Swing lows, trend lines, round numbers, equal highs, these are the liquidity magnets. So what do you do with this understanding? You stop placing your stops at the obvious levels. You place them beyond the next significant liquidity pool in the direction of invalidation. If price needs to go through that pool to invalidate your trade thesis, then your stop makes structural sense. If price just needs to breathe, sweep a minor low, and come back, then your stop does not need to be below that minor low. It needs to be below the pool that, if swept, means the trade idea was wrong from the start. Now I want to go into depth on something that trips up traders who are learning these concepts: the difference between a manipulation sweep and a genuine structural break. This distinction is absolutely critical because they look almost identical in real time, and the entry decision hinges entirely on reading which one is happening. Look at this candle right here. Price pushes below a significant swing low. It goes lower than everything around it. The candle has a long lower wick, and then within the same candle or within the next one or two candles, price closes back above that swing low. That is a manipulation sweep. The hallmarks are fast displacement below the level, inability to sustain price below it, and an immediate reversal close that reclaims the zone. The sweep happened, the liquidity was taken, and the market reversed. Now look at this candle. Price pushes below the swing low. The candle closes below it. The next candle opens and pushes further below. The pullback cannot get back above the broken level. This is a genuine structural break. The difference is the close. The body of the candle relative to the broken level tells you whether the move below was conviction or manipulation. Here is the practical rule. When price wicks below a swing low but closes above it, consider the wick as a liquidity sweep and watch for bullish confirmation above the level. When price closes below a swing low and subsequent candles confirm the break without reclaiming it quickly, respect the break as structural. But here's the trap that catches even experienced traders. Sometimes what looks like a genuine break is actually a two-step manipulation. Price breaks below the swing low and closes below it. Looks genuine, but then the next several candles consolidate just below the level, and then one more push lower, a new swing low forms, and then the mother of all reversals happens, sweeping everything back up through the original break level and beyond. This is the double liquidity sweep, and it is one of the most powerful reversal setups in the market. The double sweep works because the first break below the level shakes out the bulls who were holding. Now they are either flat or short. The second push lower stops out even the traders who waited for confirmation of the first break before entering short. Both groups are now on the wrong side. And then price reverses violently because the selling pressure has been exhausted and the buy side liquidity above the range is still sitting there waiting to be taken. Look at this example right here. First sweep below the swing low. Some bulls are stopped out. Price consolidates. Traders who missed the first break think they are smart by waiting. They enter short on the consolidation, then the second sweep, new low, stops out the second group, and then the impulse higher begins. Within a few candles, price is back above both sweep levels and driving toward the highs. The only traders who made money were the ones who identified the structure, anticipated the double sweep, and entered long on the reaction from the second sweep low. How do you identify when a double sweep setup is forming? Watch the momentum of the displacement. When the first break lower is impulsive and followed by a deep displacement, it may be genuine. But when the first break lower is moderate, the candles have large wicks and price immediately begins consolidating in a compressed range below the level. That compression tells you something. It says the bears are not in control of this move. If bears were truly in control, they would be pushing price away from the break level aggressively. The fact that price is hovering just below the level, not making new significant lows, suggests the move below was a liquidity hunt, not a structural break. Let me now bring in a concept that ties the liquidity understanding to the structural understanding and explains why the highest probability setups form where they do. This concept is the premium and discount framework. It sounds simple, but the application is profound. Every range from the lowest low to the highest high within a structural move can be divided into two halves. The upper half of the range is the premium zone, prices that are above the midpoint of the range. The lower half is the discount zone, prices below the midpoint. The logic is straightforward. In a bullish move, you want to buy at a discount relative to the range, not at a premium. In a bearish move, you want to sell at a premium, not at a discount. Now here is how this interacts with the fair value gap and the liquidity framework. When price creates a bullish displacement, it often leaves a fair value gap somewhere in the move. The most powerful fair value gaps, the ones that produce the cleanest reactions, are the ones that sit in the discount portion of the recent range. Because when price pulls back to that level, it is simultaneously at a fair value gap and at a discount price relative to the range. Two reasons to buy at the same location. Similarly, the most powerful sell setups occur when price pulls back into a bearish fair value gap that sits in the premium portion of a range. Price has moved impulsively lower, left a gap in the supply zone, and when it retraces into that gap at a premium level, both the imbalance and the overpriced condition are aligned. Those two reasons converge to create a high probability entry. Look at this chart. After the bullish displacement we identified earlier, we can draw the range from the low of the displacement to the current high. The midpoint of that range is here. The fair value gap we identified earlier sits here. In the lower half of the range, it is in the discount zone. When price returned to this fair value gap, it was returning to a discounted imbalance level within a bullish displacement. That is the convergence. That is why the reaction was clean. But notice that price did not just touch the fair value gap and immediately launch. It entered the fair value gap, spent a few candles inside it, and then showed a specific behavior before the next leg higher began. That behavior is what we look at on the lower time frame for the actual entry trigger, and this is where confirmation comes in. Confirmation on a lower time frame during a higher time frame. Fair value gap reaction is looking for one specific thing, a change of character on that lower time frame. When price is pulling back into the higher time frame fair value gap, you drop to the 30-minute or 15-minute chart and you watch for the first sign that the pullback is ending and the original direction is resuming. That sign is a displacement on the lower time frame that breaks the most recent lower high in the pullback. A lower time frame change of character. Here is what that looks like in practice. On the 4-hour chart, price is inside the fair value gap, and the body of the last 4-hour candle is sitting within the zone. You switch to the 15-minute chart. On this 15-minute view, you can see a sequence of lower highs and lower lows. The pullback structure in detail. Then, here it is. Price makes one more low and then displaces upward, closing above the previous lower high on the 15-minute chart. That is the 15-minute change of character. That is your entry trigger. You enter long here, you place your stop below the last significant low on the 15-minute chart, and your target is the next pool of buy-side liquidity above the 4-hour structure. The reason this multi-time frame entry model is so powerful is that it gives you a very tight stop loss relative to a very large potential move. Your risk is defined by the lower time frame structure. Your reward is defined by the higher time frame structure. And the probability of the trade working is enhanced by the alignment of all the elements. Higher time frame fair value gap in the discount zone within a bullish change of character and break of structure, confirmed by a lower time frame entry trigger. Let me now address an important question that comes up repeatedly when traders learn these concepts. What about order blocks? Because the order block is one of the most commonly referenced ideas in smart money concepts, and it is also one of the most misused. An order block, in its simplest and most accurate form, is the last opposing candle before an impulsive move. If price has been moving lower and then suddenly displaces higher aggressively, the order block is the last bearish candle before that displacement began. The logic is that institutional orders, which ultimately drove that displacement, were placed during that last opposing candle. When price later returns to that candle's zone, usually its body, or more specifically the upper half of its body, those same institutional levels are being tested again. But here is the trap. Too many traders are marking every single opposing candle before every move as an order block and treating each one with equal importance. That is not how it works. The order block that matters is the one that preceded a genuine displacement that caused a structural shift. If the move after the order block was modest, overlapping, and did not create any meaningful structural change, then the order block has limited significance. The size of the institutional footprint left by the order block is measured by the magnitude and quality of the displacement that followed it. So when you identify an order block, the first question is, what happened after this candle? Did price displace aggressively with full-bodied candles, breaking structure and creating a fair value gap? If yes, that order block matters. If the move after it was moderate, overlapping, and choppy, then that candle is not functioning as an institutional zone. Look at this candle right here on the chart. The last bearish candle before this impulsive bullish displacement. Large body, closes near its low, and then the next candle opens and drives upward with conviction. This is a clean order block because the displacement that followed it was impulsive, created a fair value gap visible on this time frame, and broke through the previous swing high. All three of those elements validate the significance of this order block. Now here is the added dimension that makes order blocks more nuanced and more powerful. When you identify a valid order block, you are not just marking a level, you are identifying a location where institutional interest exists. And institutional interest at that level makes it a natural zone of demand or supply that will likely be defended when price returns to it. Watch what happens when price retraces back to this order block zone. It enters the upper half of the candle body. A wick forms, the next candle closes above the order block midpoint, and then price continues in the direction of the original displacement. That is the order block reaction, clean, predictable, and repeating. But now, contrast that with what happens when an order block gets completely engulfed on the return. Price comes back to the order block, trades through the entire body, wicks below the candle's low, and then even closes below the order block. At this point, the order block has failed as a demand zone. The institutional level there has been absorbed. The original logic is no longer valid. Do not continue to hold or re-enter at a failed order block as if it is still valid. When an order block is fully engulfed with body closure through it, it is broken. Move on. There is a relationship between order blocks and fair value gaps that creates some of the highest quality setups. Sometimes the fair value gap from an impulsive move sits directly above or below the order block that initiated the move. When price pulls back, it hits the order block first, and then the fair value gap might be slightly above it, or the fair value gap might overlap with the order block zone. When the fair value gap and order block are stacked or overlapping, you have a zone that has two independent reasons for institutional interest converging at the same price level. These confluent zones produce the cleanest entries and the most reliable reactions. Let me walk through how to construct a trade using everything we have covered so far, because the concepts only have value when they are applied in a logical, step-by-step sequence. Step 1. Determine the higher time frame structure. On the daily chart, is price in a bullish market structure, creating higher highs and higher lows, or bearish, lower highs and lower lows? Has there been a recent change of character that shifts the direction you should be looking at? Identify the current structural bias before doing anything else. Step 2. Identify the direction the market needs to move to take liquidity. On the daily chart, where are the nearest significant swing highs and swing lows? Which direction would price move to sweep the largest pool of liquidity? Does that direction align with the current structural bias? If the structural bias is bullish and the nearest significant liquidity pool is a buy-side cluster above recent highs, those two elements are aligned. You are looking for long positions. Step 3. Drop to the 4-hour or 1-hour chart and identify the most recent displacement that occurred in the direction of the higher time frame bias. That displacement should have created a change of character and a break of structure on this lower time frame. Identify the fair value gap and order block from that displacement. Step 4. Determine if the current price is at a discount relative to the range created by the displacement. If price has pulled back into the discount portion of the range and is approaching the fair value gap or order block, you are at the entry zone. Step 5. Drop to the 15-minute chart and wait for a lower time frame change of character as confirmation. You are watching for price to make a swing low within the fair value gap or order block zone, then displace upward and break above the most recent lower high on the 15-minute chart. When that break occurs, you enter on the close of that break candle or on a slight retracement into the fair value gap created by that lower time frame displacement. Step 6. Place your stop below the lowest point within the entry zone, below the sweep of the order block, or below the lowest wick inside the fair value gap. The stop is tight because your entry is precise. Step 7. Your first target is the nearest internal liquidity pool, the equal highs or a fair value gap on the upside. Your final target is the external liquidity pool, the buy side liquidity above the significant swing high that was driving your trade thesis from the beginning. That sequence, from higher time frame bias, through liquidity identification, through entry zone selection, through lower time frame confirmation, through entry and stop placement, through target identification, is the complete framework. Every element is connected. You do not skip steps. You do not enter just because price is at a fair value gap without the structural alignment. You do not enter just because of structural alignment without the entry zone precision. The full sequence produces the probability. Any partial application reduces it. Now let me address something that is crucial for applying this in real markets: the session timing and how it affects liquidity sweeps. The market does not behave the same at all hours. The New York session open, the London open, and the early morning Asian range hours each have specific characteristics that affect how these setups form and play out. The Asian session, roughly from midnight to 6 a.m. New York time, is typically a consolidation period. Price ranges within a relatively tight band, accumulating orders on both sides. Equal highs form at the top of the Asian range. Equal lows form at the bottom. By the time London opens, there is a defined range with liquidity sitting above and below it. London opens and sweeps one side of the Asian range. This is not occasional, it is structural. The London session open is specifically characterized by displacement moves that target the nearest liquidity pool from the Asian range. Most of the time, you will see London sweep the Asian high or the Asian low, take that liquidity, and then set the directional bias for the day. Now here is the insight. When London sweeps the Asian low, it is taking sell-side liquidity. That sell-side sweep often precedes a bullish move. When London sweeps the Asian high, it is taking buy-side liquidity, and that often precedes a bearish move into the New York session. The sweep tells you which side of the market has been shaken out and what direction has the momentum cleared to move. New York opens a few hours after London, and the New York Open is characterized by its own displacement moves. Sometimes New York confirms the London direction. Sometimes, and this is the setup known as the London-New York reversal, New York reverses what London established. When London pushed up during its session and created obvious long positions among retail traders, New York can come in and reverse that, sweeping the London session highs and then driving lower through the day. The practical application of session timing is this. The highest quality setups form at the London Open and the New York Open. During these windows, the displacement moves are larger, the liquidity sweeps are more decisive, and the directional commitment is greater. Outside of these windows, during the New York lunch hour, during the transition from New York to Asian session, the market often chops, overlaps, and creates false signals. Learning to identify when you are in a high-quality session window versus a low-quality chop period will significantly filter your trade entries and reduce the number of losing trades you take. Look at this example. This is the Asian range forming, the consolidation period, the equal highs, the equal lows, the accumulation of orders on both sides. Now watch the London Open. Price drops below the Asian low, takes the sell side liquidity, and then, within 2 candles, it reverses and begins pushing up through the range. That sweep of the Asian low was the setup trigger. The displacement upward after the sweep is the direction, and the fair value gap created by that upward displacement is the entry zone for anyone who missed the initial reversal candle. By the time New York opens, price has already been moving higher for several hours. New York comes in, makes a slight pullback into the morning fair value gap, the gap created during the London displacement, and then continues higher into the afternoon. 2 entries were available. Both were defined by the same logic: liquidity sweep, displacement, fair value gap, confirmation. Now I want to go deeper on one more concept that connects everything and raises the quality of your analysis to a higher level. This is the concept of higher time frame institutional order flow versus lower time frame noise. Because one of the most common mistakes traders make, even traders who understand all the individual concepts we have covered, is that they operate at the wrong time frame and get shaken out of otherwise valid positions. Institutional order flow is the directional bias of the market as expressed on the higher time frames: daily, weekly, monthly. These time frames show you the true intent. A weekly chart in clear bullish structure, making higher highs and higher lows week after week, is showing you where the large institutional money is positioned. They are long, they want higher prices, and their positions are so large that they cannot simply exit them at a moment's notice. When the market has a bearish week, they are not exiting. They are absorbing sell pressure. When the market has a bullish week, it is the result of their positioning paying off. The noise is everything that happens below those higher time frame reference points. On a 1-minute chart, you will see hundreds of apparent reversal signals, patterns, and structural shifts in a single day, none of which change the fact that the daily chart is in a clear uptrend. The lower time frame setups that align with the higher time frame institutional order flow are high probability. The lower time frame setups that try to trade against the higher time frame order flow are low probability, and most of them will fail. Here is how to use this practically. Before you mark up any lower time frame chart, open the weekly chart. Ask yourself, where is price relative to the most recent significant weekly swing high and swing low? Is price below a weekly fair value gap that is acting as resistance? Is price sitting above a weekly order block that has not been retested? Is the weekly structure bullish, bearish, or ranging? The answers to to these questions set the context for everything you will do on the lower time frames. Then move to the daily chart, repeat the analysis, then move to the 4-hour chart for your trade structure, then to the 1-hour chart for your entry zone, then to the 15-minute for your trigger. By the time you're looking at the 15-minute chart, you should already know the weekly and daily bias, the 4-hour structural shift, and the 1-hour fair value gap or order block you are targeting. The 15-minute is just showing you the final confirmation before pulling the trigger. This top-down analysis is what separates traders who use smart money concepts effectively from those who use them as a collection of patterns to look for in isolation. The patterns, the fair value gaps, the order blocks, the liquidity sweeps are everywhere on every time frame, but the ones that produce clean, consistent results are the ones that are nested within a clear, aligned top-down structure where every time frame agrees on the direction. Let me show you a trade that fails. Here is a trader who sees a beautiful order block on the 15-minute chart. Price has swept below a swing low, created a displacement upward, and left a clear 15-minute order block at the origin of that move. The entry looks perfect in isolation, but zoom out. On the 4-hour chart, price is inside a bearish fair value gap that has been acting as strong resistance. On the daily chart, price has broken structure lower and is in a clear downtrend. That 15-minute long setup is fighting a 4-hour and daily bearish context. It might work once, it might even work twice, but over time, buying against the higher time frame trend is a losing approach because the institutional order flow that matters most, the flow on the higher time frames, is working against you. Now here is the same 15-minute order block, but in a different context. On the 4-hour chart, price is above a clean bullish fair value gap that just got retested and held. On the daily chart, price recently created a bullish change of character and break of structure. Now that 15-minute order block is aligned with both the 4-hour and daily bullish context. Taking that long is working with the institutional order flow, not against it. That is the setup that you take. I want to address one more important topic before we close out because it directly affects how you manage trades once you are in them. This is the concept of internal versus external liquidity targets and how price typically moves between them. Once you are in a trade and it begins to move in your direction, the question becomes, where does this move end? The answer is always the next pool of liquidity, but there are two types of liquidity targets to consider: the internal targets and the external targets, and price typically addresses them in sequence. Internal liquidity is everything between your entry level and the external swing high or low. Equal highs inside a range, small consolidation zones with equal levels, minor fair value gaps that got left behind during the move. Price will often pause at or react to these internal liquidity pools before continuing to the external target. So if you entered long at a fair value gap and your ultimate target is the external buy-side liquidity above the swing high, you need to account for the internal liquidity pools that price will encounter along the way. Some of these internal pools are minor, and price will slice through them without slowing. Others are more significant and will produce a pullback before continuation. The way to assess the significance of an internal liquidity pool is to look at how much time price spent creating it. Equal highs that formed over several sessions, during which many traders place stops above them, represent a larger concentration of orders than equal highs that formed in a 1-hour range. Time at level creates significance. The practical application is this: if you are in a long position and you know there is a significant internal liquidity pool between your entry and your target, be prepared for price to stall or pull back at that level. You can either choose to take partial profit there and ride the remainder to the external target, or you can hold the full position with a stop that is beyond the level of invalidation, meaning below the entry zone structure that gave you confidence to enter in the first place. The mistake is holding a full position through a major internal liquidity sweep and getting stopped out of a perfectly valid trade because you did not account for the move price needed to make to reach that internal pool. You were right about the direction, right about the overall move, but you sized your trade in a way that did not give the position room to breathe through the necessary liquidity hunt along the way. Here is what optimal trade management often looks like. You enter at the fair value gap with the full position. Price moves to the first internal liquidity pool, equal highs from the previous consolidation, and stalls. You close 50% of the position there, locking in profit. You move your stop on the remaining position to break even. Price sweeps just above the equal highs, takes the liquidity, pulls back slightly, and then continues driving toward the external target. Your remaining position captures the rest of the move. You have locked in profit on the partial close, removed risk from the position entirely by moving to break even, and you are holding a risk-free position toward the ultimate target. That is not just money management, it is liquidity-aware trade management. You are using the structure of the market, the locations of liquidity, to make precise decisions about when to take partial profit and when to hold. This is the difference between managing a trade mechanically and managing a trade intelligently. Let me now tie everything together through one complete trade that uses every concept we have discussed, because seeing the full chain of logic from beginning to end is the best way to internalize how these concepts work together. We are on the daily chart. The weekly bias is bullish. Higher highs and higher lows on the weekly, price above a significant weekly order block. The daily chart shows a recent bullish break of structure. Here is the impulsive candle that closed above the previous daily swing high. Following that break of structure, price pulled back and created a daily fair value gap right here. A clear imbalance left by the displacement candle. We drop to the 4-hour chart. On this view, we can see the structure more clearly. The daily fair value gap corresponds to a zone between these two candles on the 4-hour chart. Inside that zone, there is also a 4-hour order block. The last bearish 4-hour candle before the impulsive move higher. The order block and the fair value gap overlap in this area right here. That overlap is our premium entry zone. We drop to the 1-hour chart to watch price approach this zone. Price is pulling back from the high, moving lower in a series of lower highs and lower lows on the 1 hour. A normal corrective move against the daily bullish displacement. As price enters the fair value gap zone, we see the 1-hour candles begin to show signs of slowing. The candles get smaller, the wicks get longer on the lower end, and the bodies stop closing further below the fair value gap midpoint. We drop to the 15-minute chart. On this view, we can watch the intraday structure of this pullback. Price has been creating lower highs and lower lows consistently. Then, here, price makes what appears to be a new low, sweeping the most recent 15-minute swing low. But look at the candle. Long wick closes back above the swing low. That is a 15-minute liquidity sweep. And then the next candle is impulsive, bullish, and closes above the previous lower high on the 15-minute chart. That is the 15-minute change of character. Entry is on the close of the change of character candle, or on a slight retracement into the fair value gap created by that 15-minute displacement. Stop goes below the wick of the liquidity sweep candle, below the lowest point reached during the sweep. The first target is the nearest equal highs on the 1-hour chart, the internal liquidity. The second target is the external buy-side liquidity above the daily swing high, the pool that has been sitting there since the beginning of our analysis. Every element aligned, daily bias bullish, daily fair value gap and order block as the entry zone, 1-hour corrective structure as the pathway, 15-minute liquidity sweep and change of character as the trigger, stop below the sweep low, targets defined by internal and external liquidity. That is the complete trade. The market will always present variations. The pullback will sometimes be deeper. The fair value gap will sometimes be in the 4-hour instead of the daily. The entry trigger will sometimes come on the 5-minute instead of the 15-minute. But the logic, the sequence of structure, liquidity, displacement, confirmation, and execution, that logic does not change. It is the same in Forex, in equities, in futures, in crypto. It applies to the 1-minute chart and to the monthly chart. Because markets are driven by the same force regardless of what is being traded or what time frame is being viewed. Institutional money seeking liquidity, filling orders, moving price from one pool to the next. The final thing I want to leave you with is this. The biggest shift in thinking that these concepts require is moving from a price prediction mindset to a price reading mindset. Retail traders spend enormous energy trying to predict where price will go. Smart money concepts teach you to read where price is going based on the structure, the liquidity, and the displacement. You are not predicting, you are reading. When you look at a chart after studying these concepts deeply, you should be able to point to the chart and say, price needs to reach that pool of liquidity above these equal highs. When it does, given the current structure, it will likely reverse and look for the sell-side liquidity below these swing lows. And when that sweep happens, if price creates a displacement back upward through the order block zone in the daily structure, the long setup will be active. That is a narrative built on reading, not prediction. You are not guessing, you are mapping. The chart is not a random walk. It is the record of institutional order filling, liquidity hunting, and balance seeking. The candles are not just colored bars, they are the footprints of massive institutional activity. The wicks are not random, they are hunts. The gaps are not accidents, they are imbalances demanding to be filled. The structure is not arbitrary. It is the story of who is in control and which direction the market needs to move to find the orders it requires. When you fully internalize that understanding, you will look at a chart and see a living, logical system instead of an unpredictable chaos machine. You will have patience because you understand that price always returns to its inefficiencies. You will have confidence because you understand that liquidity pools are real locations that price gravitates toward. You will have precision because you understand that entries are not about being at the right level. They are about being at the right level with the right structure, the right confirmation, and the right context behind you. That precision, that patience, and that contextual understanding are built on everything covered in this lesson and is what actually makes a trader consistently profitable. Not a secret indicator, not a magic pattern. The understanding of what price is doing, why it is doing it, and where it is logically going next. And that understanding starts with seeing the chart the way it actually